Do banks and insurance companies make money the same way? The question about how do banks different than insurance companies with respect to their revenue models, this is a very important question because you want to be able to invest in institutions that provide the highest and greatest return. Now, the banks typically get money from their interest income, which is the difference between what they charge you and what they have to pay to get that money. They also pay for the fees on credit cards, on the account maintenance fees, transaction fees, investment services, and they also have trading income as well as other financial services and products that they would sell. So basically, banks are basically fee driven and service fee driven in all of their banking environments. Insurance companies are a little bit different in how they make money in the sense that they charge premiums for insurance or other types of coverages that people desire, health, critical illness, etc. You might be familiar with home, auto, etc. So they charge premiums to get their income. They do have on those premiums, they do make investment income. They do have other types of fees associated with some of their products, but the majority of their income comes from the premiums they charge. Okay, to summarize, the key differences are first in revenue sources. Banks primarily earn from interest and fees on financial services, while insurance companies primarily earn from premiums and investment income. With respect to risk management, banks manage credit risk, the risk of loan defaults, interest rate risk, and liquidity risk. Insurance companies manage underwriting risk and risk of claims exceeding premiums, and as well investment risk. Regulation, and in terms of regulation, both are very heavily regulated, but the regulatory frameworks and requirements differ, reflecting their distinct business models. To summarize even further, the bank's greatest risk is to not get paid back the loans that they've provided. The insurance company's greatest risk is to have claims against the insurance pool that the premiums did not cover. So they have two different types of models. Now, with the insurance companies, there's one extra benefit that they do get, and that's what's called lapses. There's lots of people that will pay into the insurance for a period of time and then will just quit. And the insurance that they were paying for lapses and they're not covered. So there's lots of potential in the life insurance companies to get, or all insurance companies for that matter, to get a lot of free money on the basis of premiums being paid and then people quitting them. So they will make a higher return long run, typically, when premiums are paid and then no coverage is provided. This provides a greater investment pool for the insurance companies to make money, and sometimes they do offer higher return rates than the banks would.